Bitcoin and other cryptocurrencies have quickly become a significant part of modern finance, and many people are earning, trading, and using digital currencies every day. However, even though these digital assets are decentralized and seem outside the traditional banking system, they are not outside the reach of tax authorities. If you have earned Bitcoin in any form, it is critical to understand how to report those earnings correctly on your tax return. Failing to do so can result in fines, penalties, and unnecessary complications. In this video, we will walk you through everything you need to know to report your Bitcoin income and transactions accurately, making the process simpler and less intimidating. The first thing to understand is what constitutes a taxable event. In most countries, including the United States, taxes are owed when you sell Bitcoin, trade it for another cryptocurrency, or spend it to purchase goods or services. Simply holding Bitcoin in your wallet is not a taxable event, but the moment you convert it into something else with value, the tax obligations are triggered. Receiving Bitcoin as a form of income is also considered taxable. This includes Bitcoin earned from mining, working for an employer or client who pays you in Bitcoin, or any other form of compensation. The key principle is that whenever you receive Bitcoin that has a measurable monetary value, it counts as income, and the tax authorities expect you to report it. Once you know what needs to be reported, the next step is to determine the value of your earnings. For each transaction, you need to calculate the fair market value of Bitcoin in your local currency at the time the transaction occurred. For example, if you sold 0.5 Bitcoin when the market price was $5,000 per coin, the taxable income from that transaction is $2,500. Similarly, if you mined Bitcoin or received it as payment, the income is equal to the value of the Bitcoin at the moment you received it. Maintaining precise records is crucial here. You should track dates, amounts, the value of Bitcoin in your local currency at the time of each transaction, and the purpose of each transaction. This information will form the foundation of your tax reporting and help ensure accuracy. When it comes to reporting, different types of Bitcoin activity are handled differently on your tax forms. Income earned from Bitcoin, such as payments for services or mining rewards, should be reported as ordinary income. If you are in the United States, this means including the value of Bitcoin on your Form 1040, alongside wages and other income. When you sell or exchange Bitcoin for a profit, the gain is considered a capital gain. Capital gains are reported separately and calculated as the difference between the value when you acquired the Bitcoin and the value when you sold or exchanged it. In the US, this is typically done on Form 8949 and Schedule D, which allow you to itemize each transaction and summarize your total gains or losses. Other countries have similar frameworks, though the specific forms and reporting requirements may vary. It is essential to consult the guidelines specific to your country or region to ensure full compliance with local tax laws. Tracking gains and losses accurately is essential because losses can offset gains, reducing your overall taxable income. If you sold Bitcoin for less than you initially paid for it, this constitutes a capital loss. Capital losses can be used to offset capital gains from other investments, and in some cases, they can even reduce ordinary income up to a certain limit, depending on your local tax regulations. Without proper record keeping, it becomes nearly impossible to calculate these losses correctly, and you might miss out on legitimate tax reductions. Therefore, keeping detailed, organized records of every transaction, including purchases, sales, trades, and payments, is not just a good idea, it's necessary for accurate tax reporting and compliance. Managing cryptocurrency records manually can be overwhelming, especially if you have multiple transactions or trade on several exchanges. This is where crypto tax software can be incredibly helpful. These tools automatically track transactions across different wallets and exchanges, calculate gains and losses, and generate reports that are ready to be submitted with your tax return. Using software not only saves time but also reduces the chance of errors and ensures you do not overlook any transactions. Many of these platforms can even handle complex situations such as hard forks, airdrops, and staking rewards, which can have unique tax implications. Finally, it is important to stay informed and, when in doubt, seek professional guidance. Cryptocurrency taxation rules can change, and they may vary depending on your country or even your local jurisdiction. A tax professional who understands cryptocurrency can help you navigate complicated situations, ensure your filings are accurate, and even provide advice on strategies to minimize taxes legally. Proper reporting allows you to enjoy the benefits of Bitcoin and other cryptocurrencies without worrying about legal or financial consequences. By staying organized, maintaining accurate records, using the right tools, and consulting professionals when necessary, you can handle your Bitcoin taxes confidently and efficiently. Reporting Bitcoin earnings may seem complex, but with careful planning and attention to detail, it is completely manageable, and you can ensure full compliance while keeping more of your hard-earned cryptocurrency.